turbulence up ahead. Back for another edition of the Wealthy Pilots Podcast with Scott Osborn. Scott, technically we're taping this before tax day. We're dropping it, I think, on tax day, actually. But your tax return is kind of your report card. So kind of 3 grades we can't ignore when it comes to our taxes, right? So that's the conversation this week. My friend, how you doing?
Really good, man. Really good.
Yeah. Were you all set? Did you do a good job? Did you get a good report card on your taxes there?
I hope so. I'll say I never like the number.
Who does?
I know that much. So it feels like too much every year, no matter what. But
right.
That's okay.
And the funny part about that, and that's a great tie-in to get us started, is that we are in a historically low tax environment, right? From a federal standpoint. Now, everybody in every state's taxing us the yin yang everywhere else, but the old saying goes, Scott, it's not what you make, it's what you keep, right? So, how's your tax strategy? And are you thinking about it just from a year-to-year basis when you really shouldn't be thinking about retirement as we're getting closer? We need to start thinking forward as well.
Yeah, when I think of taxes, there's 2 parts. There's kind of a strategic part, which is the way I always verbalize that with clients is like, hey, when you're retiring and you're 65 and you're getting ready to pay yourself in retirement instead of getting a paycheck, I want you to be in a spot where you're looking back saying, man, I'm glad we did this versus, man, I wish we would have,
right.
And so to me, that's one portion of it. It's just making sure that we're kind of setting ourselves up strategically, and we can talk through a couple of those things.
Yeah.
And then there's this other tactical portion, which is kind of like year to year, are we doing the right things? Are we working on things the right way? Are we being intentional with where we're saving?
Okay.
Are we being intentional with managing the tax classification of our investments? Some of this is kind of tough if you're like just a W-2 pilot and that's it. It kind of is what it is. You're going to make what you make, and then you're going to get the standard deduction, and that's that.
Right. But a lot of people have a lot of other things going on, right? So is the effective tax rate, is that the number that truly matters? That's the one that really moves the needle, is the effective tax rate?
Yeah, the effective tax rate, that's the number, right? So, I think a lot of guys are like, okay, I'm going to go look at the marginal tax bracket, and I'm going to see what my income is, and then it's in the 35%, I'm paying 35%. Right. Well, not necessarily. Ultimately, the dollars paid in taxes, right? That's the tax bill. The tax bill divided by the money you made, that's your effective tax rate. And we want that to get lower. Yeah,
because if you're making more but losing more, right, you're not in a good position. My wife and I just came from our CPA, just a little bit ago, and she's like, "Hey, you guys moved up a tax bracket, which is great, right?" And I'm like, she saw my face. She's like, "Well, don't panic. Doesn't mean every dollar is at that new rate, right?" Yeah. So that's another place where people have a disconnect too.
Yeah. Well, and there's a lot out there, right? If you're, rental landlord of sorts, if you have a rental, if you Airbnb it, there's different things you can do with depreciation to help, and different write-offs and what have you. And so you want to make sure, and I do recommend everybody have some sort of side hustle. Most of our guys have time for that, especially if they're established in their career. They got good flexibility and all that.
I think we almost have to at this point in life, right? But
well, it's helpful from a tax standpoint for sure. If you have some sort of side hustle that's self-employed, and it is making money.
And it's helpful if you got 6 kids too, or 7 kids.
Yeah. I don't know if it offsets for sure. I still feel on the losing end of my bank account feels on the losing end of that deal sometimes with all those girls. But yeah, if there's something we can have going on, some sort of side hustle that we can, run some cash through.
Right.
And obviously if it's losing money every single year, you're going to be an audit risk. But if it's actually something you care about and it's a way to diversify income sources, that to me is a really, really good way. But again, setting that aside, right? If we just look at like, okay, how do we set ourselves up so in retirement we're really, really happy with what we've done? This is where I think you got to look at, how much am I tax deferring? How much am I putting over into Roth? How much am I putting into taxable? And again, the more you make, the more you're going to pay in taxes typically. And so there might be a balancing act where we want, the employer contributions typically for most of the airlines all go to pre-tax.
Okay. Right.
Most of our guys put their money in pre-tax 401k. But there might be an argument to be made to say, hey, maybe we should put your contributions based off of what tax bracket you're in over in Roth. For some of our younger, more junior guys, a lot of times we're saying, hey, put your contributions in the Roth. And then once you get up to that 35% tax bracket,
right,
then let's come over and put them back in pre-tax.
And ask about the backdoor Roth if you haven't been doing that, right? That's worthwhile to say, okay, maybe it's time to implement that strategy.
Yeah, for sure. I mean, if you don't have an IRA balance hanging out there, we definitely want to take a look at, or even if you're doing it smaller, we might look at converting that over. And again, especially for our junior folks, if you got old TSP money, you got an old 401k from a previous job, man, get that stuff into an IRA, get it converted at these lower rates, because if you're at 24, 27% tax bracket, the odds of you paying less than that in retirement are probably pretty low. Because again, we got to take a step back and say, man, what are we at? $42 trillion in debt, something like that here soon.
39.
Yeah, 39. It's gaining $1 trillion a month, so we'll be there soon. It is out of control, not sustainable. There's going to come a time where taxes have to go up. Well, the One Big Beautiful Bill Act locks some of that in place at least for the near term.
A couple of years, right? But after that, right?
I mean, you need all three. You need both houses of Congress and the presidency to be of another party to change that back, in essence.
And let's be honest, right? Given the political, ridiculousness that we got going on, if the other side comes in 28, they're probably going to change everything just to be contrarian, if nothing else, right?
For sure.
So I mean, we could be looking
now where they're low.
Yeah, right. No, they are. They're historically low, and people don't realize it, but they are.
Yeah, I mean, and so if there's things we can do to get money into Roth, now is a great time to do it.
You basically got 2.5 years, right?
Yes.
So
now is a great time to do it.
Yeah.
So the next thing I would say is kind of understanding what your income sources are now and then in retirement. Okay.
Right.
Again, if you're a W-2 pilot and that's your only income, then that's pretty simple. You're getting a paycheck from a corporation. You're on a W-2. It's straightforward. If you're getting military pension, maybe VA disability benefits, maybe side income from rental or a side hustle, spousal income, your income. Back to what we talked about before with financial modeling, we want to get all these income sources in there into your plan. We want to understand the taxability of all those income sources. Not all of those are taxed equally. Then we want to understand the survivability of those income sources. And so, the taxability, the sustainability, and then the survivability. So when we look at those income sources and understand them, again, we can kind of model what retirement is going to look like and say, okay, if you pass early and your VA benefits go to zero, and you're a 100% disabled veteran, I mean, that's $4,500 a month. That's going to zero. That's meaningful to your spouse. That's tax free, by the way. So that's probably more like $7,000 a month pre-tax that your spouse is losing out on. We should have an understanding of what that means to the retirement plan.
Yeah, that's huge.
So all those things impact the tax classification and the tax picture in retirement. Speaking of that same scenario, us men tend to die early. I know that's going to happen in my house. My wife's not on time for anything. And she, when we get into retirement, if I pass first, the next year she's filing as a single taxpayer.
Right.
And all of a sudden,
often overlooked because we're just not used to doing it. Right.
100%. And all of a sudden she's in a single filer tax bracket, paying gigantic required minimum distributions. And so we're pretty aggressive in getting things over into after tax because I just don't want the risk in retirement. My balance might be lower because it's not all pre-tax, but it's going to be 100% ours.
Well, we often think about income buckets or income in diversification. Obviously, that's everywhere on YouTube and every place else. But tax diversification is just as important, right? So as you were talking about that a second ago with the different types of accounts, you got to be thinking in terms of those two big pieces of the strategy working together there, especially when somebody passes.
If I'm the ultimate procrastinator and I do nothing but let the airline max my 401k out every year, and I don't do any contributions, I don't do any other saving, I'll probably still end up with a couple $1 million in my 401k. It's nice.
Great.
But it's all pre-tax.
Well, you end up with 70-something% of that.
Yeah. That individual is very susceptible to.
Yeah. Cause Uncle Sam's going,
risk.
Gimme. Right.
Yes. So. And so if taxes go up, I mean, that just, and you're used to getting $5,000 a month from your investments and then taxes go up by X%. well, you just got to increase your distributions to sustain your lifestyle.
Yeah.
It's very, very, the lack of tax diversification is probably the number one thing we deal with when we meet with folks.
Yeah, I'm sure.
And it's just a very, very common, I don't want to say lack of understanding because it's not super complicated. When we take time to talk through it, it's like, yeah, it makes sense and we diversify. But it's just one of those things that when procrastinated on, it's very hurtful to the retirement plan. And it maintains a lot of tax concentration risk that's just not necessary. You don't need to retain that risk in your retirement. So.
Right. So, I mean, if you're going to your CPA, your tax person, and, you're not getting a good report card back, right, then you need to be talking with them. Now, but be honest, be fair too. Their job is last year, looking at the past. Unless you're working with a CPA who's also a financial professional looking forward, they're probably not thinking about future tax strategy, right? So that's why you got to marry these two things, especially. And the onus is on us, Scott, as we get over 50 to start talking with our advisor and saying, hey, let's get more tax efficient. And what do I need to take to the CPA or having you guys work together, things of that nature, right? That financial team.
Absolutely. And again, you don't want your tactics to be year to year to be misaligned from your long range strategy.
Right.
And frequently they are.
Yes.
And so, as we kind of put a pin in this thing, the last thing I would do is I'd look at my tax return and I would make sure that I'm doing all the things that I can do to save and invest tax efficiently and reduce my taxable income as much as I can. So making sure I'm maxing my 401k. Again, most of our senior guys are going to do that just from the employer contribution. Mm-hmm. But making sure I'm maxing my 401k, making sure I'm taking care of my catch-up contributions if I'm over 50, making sure I'm doing a backdoor Roth. If you're not doing a backdoor Roth, you should be. If you feel like you make too much money or you got too much in an IRA or whatever, we can absolutely work around those things. If you're not doing a backdoor Roth, you're missing the boat. And again, if you get working on that early enough, you can have $1 million Roth IRA.
And not to cut you off, Scott, but we did an episode on that about 4 or 5 episodes back. So we can put a link in that, the backdoor Roth strategy. So
let's
that's
link it right in there. Because again, if you look and say, hey, I didn't do this, I just looked at my return. I didn't do one this year. I don't know that is low hanging fruit. Tax loss harvesting. If you have after tax investments, all this volatility that we've had in the market the past several years, you should be absolutely taking advantage of down markets to mitigate your tax bill. And if that's not happening, that's probably leaving a couple, the data behind that is it's normally 2 to 3 percentage points of after tax investment performance left on the table if you're not harvesting any of those losses. So
great
again,
point.
Those are just kind of some low hanging things that if I was just a W-2 pilot, I would be looking at. I'd be looking at where am I saving my 401k contributions at? Am I doing a backdoor Roth? Am I doing tax loss harvesting? Am I saving in the right non-401k accounts? Those 4 things we want to make sure we're getting right because that's taking care of the year to year tactics. It's also going to set the strategy where when I retire, I can look back and say, man, I'm glad we did this.
And that'll help you with that report card, get a little bit better grade from year to year as well. So as always, if you got questions and need some help before you take any action, always check with qualified professionals about your specific situation. And of course, Scott is here to help. So reach out to him with the links we've got in the show descriptions down below. You can simply go to his website, retireairlines.com. I'm sorry to say you can go to your airline, but I don't think you got an airline yet, Scott. Go to retireairlines.com.
Don't have that side hustle quite figured out.
Yeah, there you go. Retireairlines.com. Don't forget to subscribe to us on Apple, Spotify, and whatever app you enjoy using. Of course, right here on YouTube as well. Thumbs up and notification bell so you catch new episodes when they come out. That's going to do it this week for the Wealthy Pilots podcast. Scott, we'll see you next time, my friend. Have a good one.
All right. Thanks, brother. See you soon.
Hey, everyone. Real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.